Hello, trading is closed on May 2nd, 2018. We had a few calls. Let's go over them. We weren't too specific, so we thought we had a likelihood of a whipsaw, which we got. Looked for a good chance of a gap down, which we got. Thought a higher price would print at some time, which we got. Had a target of 26.2859. It did print after the close, and there was support under it. It's relevant, but until it prints in real time, it's a failed target. During the day, MEJT is ultimately lower and higher price would print, which they did. Here it gave a buy. The signal worked, but a buy in MEJT doesn't mean you enter an order to go long. It means there's a target at a higher price. In this case, had we gone just a fraction higher than this high, would have been enough. So even though we got enough to make it worthwhile, there really was nothing actionable based on this alone. Now we had one other call. We said this was a pattern with an early high and a tendency to rally into the close. Now I know it looks like quite the opposite, but let me convince you that's what this is. And it's significant because when you drop instead, it leads to lower prices unless you invalidate it by gapping up, promptly taking out this high, which I don't think is going to happen. First of all, here's your early high. This high is lower. It's a negative pattern. Tends to lead to lower prices with a market peak coming about 1:40 Central, 2:40 Eastern Time. That's about 5 minutes early. That might not be enough to convince you, but if this were a pattern with an early low, this would have an early high, and this pattern should lead to lower prices, not higher, and it wouldn't have the time frame for this low that we have here. These patterns repeat every 32 calendar days. If you want the same day of the week, you multiply 32 by 7 and get 224. You go to a website called timeanddate.com, take today's date, subtract 224, you get a series of dates. Let's take the first few that pop up. You'll see how we have a rally, a correction, a late rally on Monday. It's a pattern with an early low. This is the pattern with the early high. Note the tendency to rally into the close. The same sort of pattern is going to be seen 224 days earlier. Rally, correction, rally into the close. This lower than this leads to weakness. Sorry, this is not that pattern. This is the pattern with the early low and the times are all wonderful. And this is the pattern with the early high and the tendency to rally into the close. Let's go 224 days earlier. Here you'll see a low to high day. This is the tendency to rally into the close. The times all fit. Here you'll see a low to high day, low to high, and high goes higher. It's shouldn't have said low to high, I should say early high, early low, and this is the one with the early high and it rallies into the close. And you can go back as often as you want. Most of the time you're going to get rallies into the close, and if you don't, it spells more trouble. Here's your demarc buy signal. It doesn't really mean you have to buy. It means the market's oversold. If it doesn't get more oversold, it has to correct. It can correct in terms of price with a rally. In this case, it's corrected in terms of time. It isn't a good sign because when time runs out, you drop. Well, here's the wave count I've been using for a long time. I know a lot of people think this is a 5-wave pattern, and the reason behind it is a move this strong, they feel has to be an impulse, and this should be a triangle, and that takes us up to higher prices. I don't agree with that. First of all, this move is a 5, but everything else is a 3-wave pattern, and a pretty obvious 3-wave pattern if you look at it. These are obvious 3s. Furthermore, if impulsive, suppose I'm wrong. Suppose a strong move like this did have to be an impulse, even though there's no such rule. If that's true, you'd have to count this as a 5-wave pattern. You couldn't have a 3, which you need for a triangle. And if this is 5 waves and that's 5 waves, it would imply the whole bull market's over, which I don't think is the case. I think we're in the 4th wave, starting wave gray C down. You can't have a rule that says strong move is to be a 5 and then count this as a 3. If you're going to have rules, you have to stick to them. I've played around with the colors a bit. Here's wave 1. This is an excellent candidate for wave 2. You've got great Fibonacci imbalance. The high is right on a date I called over a month ahead of time. The first move after the Fed announcement, which lasted under a minute, you can't tell on this chart, but it was down. That's leg 1, leg 2, and then leg 3 is the biggest one. If that's wave 2, and if there's a standard fib relationship between 1 and 3, this could take us down to 21.32, rally to 23.63, and down to 20.23. It's not a guarantee, but it tells you what awaits us if that wave's over. Unless we invalidate this by gapping up and taking this out, which I can say is not going to happen as far as I'm concerned. Unless that happens, this is a very negative pattern. It should lead to lower prices with a good chance that this impulsive action continues quite a ways further on the downside. We have to clear some more lower targets to be certain of that, but it's an excellent candidate, and that's today's call.